I want to be very clear about who this video is for. If you were born before 1966, so you are 60 years old or older right now, everything in this video directly affects you or someone you love. We are going to walk through the full retirement age changes, the 2026 cost of living adjustment, the brand new law that repealed two rules that were silently cutting benefits for millions of public employees and their spouses, the exact dollar amounts at stake, and the mistakes people make right now that permanently reduce what they collect for the rest of their lives. Stay with me all the way to the end because the section on common mistakes alone could be worth thousands of dollars to you. Let us start with the most important concept in all of Social Security, your full retirement age, or FRA. This is the age at which you can collect 100% of the benefit you earned, not a penny less. And in 2026, this number has officially reached its final destination after a 42-year journey. In November 2026, the full retirement age reaches 67 for anyone born in 1960 or later, the final step in a gradual schedule that began with the 1983 amendments to the Social Security Act. That legislation was designed to reflect longer life expectancies and shore up the program's finances. It has been creeping up by 2 months per birth year ever since. So, here is what that looks like in real numbers based on your birth year. If you were born in 1957 or earlier, your full retirement age is already 66 years and 6 months or less. You may have already hit it. If you were born in 1958, your FRA is 66 and 8 months. Born in 1959, it is 66 and 10 months. And if you were born in 1960 or later, your full retirement age is 67, meaning you will not qualify for your full benefit until 2027 at the earliest. Why does this matter so much? Because the difference between claiming at the right time and the wrong time is permanent. Claiming at 62, the earliest age you can file, will reduce your monthly check by as much as 30%. And that reduction stays with you for life. Let us talk about what is actually at stake in your bank account. The maximum monthly Social Security benefit at full retirement age in 2026 is $4,152. If you retire at age 62, that drops to $2,969. But if you delay all the way to age 70, you can collect up to $5,181 per month. Think about that. The difference between claiming at 62 versus waiting until 70 is over $2,200 every single month. Over a 20-year retirement, that gap grows to more than $500,000. Now, not everyone gets the maximum benefit. Your actual amount depends on your work history and lifetime earnings, but the percentage-based hit is the same for everyone. Claim early, you lose. Wait longer, you win more. If you wait even a single month beyond your full retirement age, your benefit starts increasing, and up to age 70, every month you delay adds to that monthly check for life. The system actually rewards patience, and if you are in good health and have other income to live on, delaying can be one of the smartest financial decisions you ever make. The 2026 COLA and what it means for your check. Right now, Social Security and supplemental security income benefits for 75 million Americans increased by 2.8% in 2026, with payments to nearly 71 million Social Security beneficiaries going up starting into January 2026. That is real money added to your check every month starting this year. If you were already collecting $1,800 a month, a 2.8% COLA adds about $50 per month, or $600 over the course of the year. If you are collecting $2,500, you picked up $70 a month. These adjustments compound year after year, which is another reason why a larger base benefit, earned by waiting longer to claim, pays dividends for decades. The earnings limit for people who are still working and collecting benefits before reaching full retirement age is now $24,480 in 2026. If you earn above that amount before hitting your FRA, Social Security will temporarily withhold some of your benefits. Social Security Administration. You do get that money back eventually once you reach full retirement age, but it is worth knowing the limit so you can plan accordingly. This is one of the biggest Social Security stories in decades, and a lot of people who should be cashing in on it have no idea it even passed. The Social Security Fairness Act was signed into law on January 5, 2025, and it repealed two rules that had been quietly cutting benefits for millions of public employees and their families. Those two rules were called the Windfall Elimination Provision, or WEP, and the Government Pension Offset, or GPO. The Windfall Elimination Provision reduced your own Social Security benefit if you also collected a non-covered pension, meaning a pension from a job where you did not pay into Social Security, like many government, school, or postal jobs. The Government Pension Offset reduced spousal and survivor benefits by 2/3 of your public pension, and in many cases wiped them out entirely. Teachers, firefighters, police officers, postal workers, state and federal employees, millions of Americans were hit by these rules and never even knew why their Social Security checks were smaller than expected. The new law is retroactive to January 2024, meaning benefits for that entire calendar year were underpaid under the old rules. The Social Security Administration is required to pay the difference as a lump sum. For a retired teacher whose WEP cut was $500 a month, that is $6,000 a year in back pay for 2 years of retroactive payments, plus a permanent boost of about $6,000 annually going forward. For a widow who was zeroed out by the GPO on a spousal benefit of $1,800 a month, the swing is even larger. If you were previously denied spousal or survivor benefits due to the GPO, you need to file a new application with the Social Security Administration. This does not happen automatically for everyone. You have to take action. Go to ssa.gov or call 1-800-0772-1213 and find out if you are owed back pay or a higher monthly benefit going forward. Spousal and survivor benefits, what married couples need to understand right now. If you are married or were married, there is another layer of strategy here that is worth real money. Public employees who now qualify for spousal benefits after the GPO repeal can receive up to 50% of their spouse's full retirement amount without pension deductions. When the higher earning spouse passes away, the surviving spouse steps up to 100% of that benefit, not 50%. Every dollar the higher earner adds to their benefit by waiting to file flows directly through to the survivor's monthly check for the rest of their life. The claiming age of the higher earning spouse shapes 2 lifetimes of income. This is a decision that affects not just you, but your spouse for potentially 20 or 30 years after you are gone. If you are the higher earner in your household, the most powerful thing you can do for your spouse's financial security is delay your own claim as long as possible. Ideally, until 70. Common mistakes that cost people thousands do not do. These: number 1, claiming Social Security the moment you turn 62 just because you can. You can, but doing so locks in a reduction of up to 30% permanently. Unless you have a serious health condition or truly no other income source, this is usually a costly mistake. Number 2, not checking your Social Security earnings record for errors. Your benefit is calculated based on your lifetime earnings history. If your employer reported your wages incorrectly in any year, your benefit is wrong, and you are losing money every month because of it. Log into ssa.gov and review your earnings record today. Number 3, if you are a public employee or former public employee, not filing a new claim after the WEP and GPO repeal. As of 2026, the SSA is still processing some cases involving complex benefit histories. If you have not checked whether you are owed back pay or a higher monthly benefit, you may be leaving thousands of dollars uncollected. Number 4, claiming your own benefit before full retirement age when you are also eligible for spousal benefits. Under deemed filing rules, if you claim early, you are automatically enrolled in both your own benefit and your spousal benefit at the same time, and you receive whichever is higher, but both are permanently reduced. Waiting until full retirement age gives you the ability to make that choice strategically. Number 5, not factoring in taxes. With $4,500 or more a month in Social Security, combined with traditional IRA withdrawals or pension income, most of your benefits become taxable. Talk to a tax professional about how to structure your withdrawals so you are not handing a bigger than necessary chunk of your check back to the IRS. Here is what I want you to do right now. Go to essa.gov and log into your My Social Security account. Check your estimated benefit at 62, at your full retirement age, and at 70. Check your earnings record for errors. If you ever worked in a government job, a school, or any job where you did not pay into Social Security, call the SSA directly and ask whether the Fairness Act changes apply to you and whether you are owed retroactive payments. Do not assume someone will notify you. They may not. You have to ask. This is your retirement. You worked for decades to earn these benefits. The rules changed in your favor for the first time in a long time. Make sure you are getting every dollar you deserve. If this video helped you, please subscribe to this channel right now and hit the notification bell so you never miss an update on Social Security, Medicare, or any financial benefit that affects you and your family. Drop a comment below and tell me, what is your biggest question about Social Security in 2026? I read every single comment, and your question might become our next video.